Greg is chief economist for RealPage. RealPage essentially gets data from, I don't know, millions of apartment leases throughout the United States. And so we wanted to bring him in to really give us an idea of what he's seeing in the markets, not only in Texas, but we decided to add on Atlanta and Phoenix for you guys tonight. So with that, Greg, take it away. Let me put everyone on mute just so it's not too distracting, and we will get it going. Okay. All right, Greg. So you should be good. Everyone should be able to see Greg's slides, and then we'll send out a copy after the presentation. So take it away, Greg, and then we'll have some Q&A afterwards.
Great. Thank you very much, James. And thanks to everybody who's attending this evening. My name is Greg Willett. I am the Chief Economist of RealPage. And RealPage is a technology and analytics company that focuses on the multifamily housing space. As James said, I can see a lot of real-time data that comes out of actual property management or revenue management or other various technologies that are used, that RealPage has, that are used out there in the marketplace. And I think it's something like 16 million rental units across the US use some form of RealPage technology. So we got a lot of data. And so this evening, I'm going to talk about what we're seeing happening in the US apartment market overall. And then, as James said, focus in on some of the Texas trends and do some compare and contrast with Atlanta and Phoenix, which are a couple of other options that I think a lot of people are interested in at this point. I'll begin talking a little bit about the economy. So let's go back to March and April, when COVID began to spread and the economy began to shut down. In the country as a whole, we lost about 22 million jobs in that 2-month period. So a huge, unprecedented pullback. In the next few months, we began the rehiring process, and at this point, about half the jobs that were shut down in March and April are back, and these people are working again. If I convert that into percentage terms, the number of jobs across the US backtracked by about 13% in that 2-month period, and then we've gained back half of it. So we're still, compared to February, we're still down about 6.5% nationally. But of course, the results vary a lot by individual metro area. So let's look at what the highlighted markets have done. And I'll start us out looking toward the middle of the chart with Houston. And I said for the country as a whole, you backtracked by 13%, and then we've filled in, and now we're down about 6.5%. Well, Houston almost exactly matches what has happened in the nation as a whole in terms of downsizing and then subsequent movement toward recovery. As you can see, the other markets that we're talking about today have done a little bit better than that, and they are in the better than average performers, and in particular, Atlanta and Austin have made some really solid progress, and they're only off about 4% year over year, or currently versus February. And that puts them in the top tier across the US. The two real standouts for the nation as a whole are Salt Lake City and Indianapolis, where the whole in those two spots is down to less than 2%. So good progress here. And so as these jobs have come back, that means in some parts of the country, we've started to have some pretty significant demand for apartments again. When we hit that March and April timeframe, leasing activity in the country as a whole got cut roughly in half from where it had been at the same time in the previous year. So we struggled in second quarter. We got to third quarter, demand came back for the country as a whole, and we had demand for apartments in third quarter that actually a little bit exceeded what we did in third quarter of last year. Results were very uneven across the country, and that's something I'm going to say over and over again in this discussion, is results are very different from one place to another. But look at the leaderboard there of the markets that did best in third quarter. Dallas, Fort Worth, Atlanta, and Houston all absorbed 8,000 to 9,000 apartments. We had some really good numbers also in Phoenix, Denver, and Charlotte. And then let's look at the other extreme. Still having sizable net move-outs from Metro New York and from the Bay Area, and then basically flat performances with really no net demand in places like Seattle, Chicago, and Washington, D.C. So we've had some demand come back. Now, if you've been paying attention to what the media says, they've told you that downtowns are dead and every person who lives in the urban core is going to move to the suburbs, and the downtown is never coming back. That is a significant exaggeration of what is happening. Certainly, you do have big net move-outs from Manhattan. Downtown San Francisco is struggling. Parts of LA struggling as well. But in Sunbelt markets, you do still have positive demand for apartments in the downtown and downtown adjacent neighborhoods. It's not great demand. Certainly demand is better in the suburbs than it is in the urban core. But these Sunbelt markets still do have positive demand. I will say technically Miami was negative, but it was so barely negative, we can call that one flat. But really all across the Sun Belt, some decent demand for urban core apartments. So as demand has come back, the occupancy performances across the country have, for the most part, done pretty well. And we're really only off a little bit in the country as a whole relative to where we were last fall. And I will point out last fall, we had occupancy that was basically in line with the all-time high. And so these are healthy results. And even though we're in a recession and it's a pretty substantial recession, look at where we are in occupancy versus where we were in the last two recessions, back in 2008, 2009, and then back in 2001, 2002. So we still have a huge premium on the occupancy side of things, and that's really helping all the other metrics hold together reasonably well. There is variation by product segment, and these are numbers for the US overall, and you can see jam-packed occupancy in Class C product, still very healthy in Class B product as well. To the degree that there's a trouble spot for the nation as a whole, it's that top tier luxury product, and particularly some of the recent completions are sluggish on their initial lease up. So a little bit more of a competitive environment there. So as we look across product segments, and let's look at it differently, and it even shows up in a more pronounced way here if I look by building configuration. So really, really full occupancy in that 2 or 3 story garden apartment, a little bit less, but still okay in mid-rise product. And then whenever you get to the high-rise towers, that's where we've got some struggle on the occupancy front. Let's take a look then at the individual markets that we want to highlight here. And again, it was interesting to bring Phoenix and Atlanta into the conversation. They are certainly doing better than the Texas markets when it comes to occupancy. And I'll point out that both of those two have current occupancy that's actually a little bit ahead of where we were a year ago. You go to the Texas markets and the results are generally healthy-ish, a little bit more variation from one to the other. Dallas-Fort Worth is the standout, doing the best at this point, and then others a little bit weaker. And one that I'll point out here is Austin, which usually is the tightest market in Texas, but you can see that one has had occupancy come down 180 basis points year over year. So even though Austin's doing really well in terms of an overall economic comeback, the apartment market is really maybe underperforming expectations a little bit, and we're going to see that in other metrics as we go through this discussion as well. Let's talk about the ability to hang on to renters when an initial lease comes up for expiration. These are interesting numbers, and what you saw in second quarter all across the country as the pandemic emerged, initially there was this panic and nobody was moving at all. So resident retention went sky high relative to where it had been, in most places going up 5 to 6 percentage points quarter over quarter. As we went along through the cycle and got into late summer to early fall, people are moving around more so at this point. So we are starting to see that those resident retention numbers come down a little bit. The Sunbelt numbers still tend to be pretty healthy, but there have been some really big shifts in these gateway markets, and particularly in urban core neighborhoods within these markets. And I'll give you the worst case scenario. In almost every situation, the worst case scenario is going to be San Francisco. And downtown San Francisco has seen resident retention when a lease expires drop to the 20 to 30% range. And something that's happening in these gateway markets where we've had some big rent cuts, we'll talk about that in a little bit. Even the people who are left in these markets are really playing musical chairs to take advantage of those lowered rents. So we even see within our database a lot of people moving from one unit to another within an existing property. So that's no net change, but they're moving to a better or larger unit to take advantage of those discounted rents, and again, some of these coastal markets. Looking at the numbers for these markets that we're studying here, again, you've seen Atlanta's really the standout here, doing the best in terms of resident retention, and you can see it's actually moving up a little bit relative to where we were a year or so ago. Dallas-Fort Worth doing pretty well and holding steady. Others down a little bit. And then I'll point out again to Austin. Here's another example of where Austin is suddenly underperforming. We've had a big pullback in resident retention, so just more churn of renters moving around in that marketplace. Next, I want to talk about rents a little bit, and certainly let's start the rent topic with just a discussion of whether or not renters are currently meeting their rent obligations. And as the pandemic emerged, this was suddenly, I don't think in my 30 or so years of working in the industry I had ever been asked what is the payment rate, and are renters making their payments? And suddenly this was the number one topic of conversation. And so we were able to spin up some data to look at what's happening here. And if you have not seen it, the National Multifamily Housing Council has a great rent payment series, and we've been contributing our data to that effort, and it just tracks the share of renters who have been paying their rent each month. So we have seen a little bit of a decline for the nation as a whole, but really only from month to month. It's usually off the year ago month by only 1 to 2%. So that's not a really big problem. The numbers are off a little bit more in a handful of areas. I will point out the problem kids from the very beginning of this survey were New York, Los Angeles, Las Vegas, and New Orleans, and then more recently, Seattle and Portland have had some drop off in the payment level. But by and large, these numbers have been really good, and you can see for the markets that we're talking about today, the decline year over year is only about 1% in most places, a little bit more than that at 2% in Houston and San Antonio, but still good numbers. And so we get asked over and over again, how is this actually possible when we have lost as many jobs as we had? Certainly the number one reason is the CARES Act, which was the stimulus package that Congress passed as the pandemic emerged. And so for people who were unemployed in addition to state level unemployment benefits, for several months there, we were providing those people an extra $600 a week. And given that the majority of people who actually lost jobs were in the hospitality and retail industries and other places that are relatively low paying industries, a lot of those people actually were collecting more in unemployment than they were making when they were actually out there working. And so they were able to save up some money for the point when those extended benefits were going to run out. And they did run out in July. So most households are just getting state level unemployment at this point, but they've managed to stay afloat for the most part. Got to give the property operators some real love for what they've done here, stepped up and worked with these with the residents and make sure that they understand how they've helped them out in terms of helping them file for unemployment. They've connected them with emergency housing assistance funds that might be available on the local or the state level. Some of the property operators have actually stepped up and helped to subsidize rents for people who have gotten into trouble. And then also some kudos to the renters themselves. They've actually prioritized paying rent versus some of the other living expenses that they have. And so we don't have a lot of households that are in trouble in terms of owing a bunch of back rent when we look at this professionally managed product sector. I will point out in mom and pop communities, there's not a lot of transparency in the data. There are some indications that the payments are not as strong in that segment of the marketplace, and particularly there's some great data from the Mortgage Bankers Association that says that properties where there's been an application for forbearance on mortgages, those are almost all coming from these smaller mom and pop communities. But overall, these payment numbers are looking really good. And so, you know, I'll call out another myth that's out there if in the media, that we have huge missed rent payments and we have this wave, usually referred to as a tsunami. That is the favorite word of the media, the tsunami of evictions and foreclosures that are coming. And we are an outlier in this opinion, but we have been out there saying over and over again, that is not going to happen. There will be some increase, but it's not going to be way over the top. And I will say in that scenario, it does assume that some additional financial stimulus and assistance for unemployed people is coming, but we will see whether that ends up being true or not. So let's talk now about what we're seeing in rents for new leases that are getting signed. And you can see that, number one, I'll point out just how long this period of rent growth went. We had positive change in annual change in effective asking rents for 39 consecutive quarters. So we were 1 quarter away from a full decade of sustained rent growth at pretty solid levels. And even as we went into pre-pandemic, where from my opinion, over the past year or two, operators have been pretty conservative on pushing rents upward because they were really emphasizing occupancy, just because there was a little bit of concern that we perhaps had a recession in front of us. I think no one anticipated anything of the scale that we've seen, but a lot of property owners and operators did anticipate that things were going to slow down from where they had been. So we'd been at about 3% rent growth for a while, which was not all that aggressive relative to where we were on occupancy. So you can see for the nation as a whole, we've now gone into year-over-year rent cuts, but they're not huge at this point for the nation as a whole, only a little bit more than 1%. I'm going to return to that theme of, but the results are drastically different from one place to another and one segment of the market to another. Let's talk about the product classes first. Again, you can see overall for the US, we're down a little more than 1%. Cuts have been occurring in the Class A product really from the moment that the pandemic started. And so currently rents are off about 2% year over year in that Class A product, around 1.5% in the Class B product, and then barely negative in the Class C category. And I'll point out, these are the numbers specifically for October. October is the first month where we've seen that Class C segment go into actual rent cuts. Let's talk a little bit about who's actually renting some of this product, though. And it's been interesting. While we've got pricing coming down a little bit in Class C product, the households who are renting right now in both the B product and the C product especially are maybe a little bit better off than you would think they are. And that incomes of the new renters walking in the front door at Class C product are actually up pretty significantly over the typical income from a year ago. And so we're referring to that internally as flight to affordability. So we have people who are out there renting at this point, and they're renting some product that's maybe a little bit less expensive than what they could truly afford. I think that reflects some concern about what might happen with their employment situation moving forward. Or also an influence is, as we've not completely broken that relationship between where you live and where you work, but it's certainly less of a tie than it was in the past. And so that means people are just leaving some of these expensive metros and expensive local neighborhoods and renting in places where it's just a little bit cheaper. And so we're seeing that in just market after market. And again, as I said, huge variation from one area of the country to the next, and a spread that, again, I don't think that I've seen in multiple cycles. So in the best case situation, you have annual rent change that is not just positive, but meaningfully positive at 8%. And the two extremes are Fayetteville, North Carolina, and Boise, Idaho, have really big price increases. And then the other extreme, the Midland, Odessa, oil patch in West Texas has annual rent cuts of 31%. That one's an extreme outlier. If you exclude that one, the next biggest cuts are in the Bay Area, and they're at 15 to, I think San Francisco itself was at minus 17% as of October relative to where the pricing had been a year ago. So now keeping that range in mind, let's look at what is happening with the markets that we're talking about this evening. And again, of these markets, Phoenix and Atlanta have the advantage when it comes to what's happening with the rent positioning. Particularly, Phoenix is doing well, not as well as it was pre-pandemic when it was the country's #1 market for rent growth, but certainly some very solid growth in pricing in Phoenix. Then Atlanta, after first had a couple of months of rent cuts, but has come back strong, and now pricing is actually up a little bit relative to where it was a year ago. For Dallas-Fort Worth and San Antonio, I would call that we're basically flat on pricing. Houston, a little bit negative with rents down about 3% year over year. Keep in mind, pre-pandemic, Houston was actually the country's weakest rent growth performer. So it's not surprising that that one's a little bit under the U.S. average. And again, circling back to the comment I've made again and again, Austin's the real underperformer at this point, and that's a little bit surprising. And we've got annual rent cuts of around 5% in the Austin market. As we look ahead, something that's going to impact near-term performances is just the amount of product that we actually still have on the way. I mean, given it takes a couple of years to deliver the typical new property once it begins construction, anytime you go into recession, you still got quite a bit of product to digest. So for the country as a whole, we have close to 600,000 market rate units that are under construction and will be delivering over the next 18 to 24 months. We have seen in the past few months that starts have pulled back a little bit, but they haven't pulled back drastically. And something that we're seeing as we talk to developers and capital sources, keep in mind that property trades are continuing to happen, particularly in suburban neighborhoods, and pricing really hasn't moved from where it was pre-pandemic. So if developers are still making money flipping recently completed product in the suburbs, they're going to keep going as long as that capital is available to them. So we don't think there's going to be a drastic pullback in these construction levels in the suburbs. There could be in the urban core, although it's interesting how much faith some institutional capital sources have in the urban core, and they're not necessarily backing off from that strategy. We'll see if that continues to hold. Let's talk about some of the construction levels in these Sunbelt markets, and as is typical, these are the real development hotspots in the nation as a whole. Dallas-Fort Worth has the most absolute number of units that are under construction anywhere in the country, with about 40,000 of them underway. That'll be 4 to 5% inventory growth for DFW. Let's flip it and look at that inventory growth rate, and you can see we've got Austin at almost 7% inventory growth in the near term. Phoenix at about 6%. There's only a couple of other spots that are building that aggressively, which would include Charlotte and Nashville. So still quite a bit of product that is on the way in these areas. Houston, It's not off the charts by historical standards, but it is about double where we were a couple years ago. So certainly some significant building activity in Houston as well. And then the outlier on the construction story is actually San Antonio, which the ongoing construction volume there is actually the lowest number that we've seen in about a decade. So not too aggressive on what we're seeing in terms of new supply headed towards San Antonio. So let's put some of these storylines together, and I'll share what we think is the overall outlook and some things for you to think about as you're considering either investment strategies or operations. Certainly we think over the near term, Atlanta, Dallas, Fort Worth, and Phoenix are probably going to be in that top tier of overall performers in the nation as a whole, doing somewhat better than San Antonio and Houston. Frankly, if I'm being honest, we don't know what to think about Austin right now, because particularly if you look at the economy, this one should be doing pretty darn well, but as we've mentioned already, it's underperforming on occupancy, it's underperforming on rents. So normally we would have this one really right at the top of the charts. Our expectations now kind of put it middle of the road, and again, to some degree, we don't know what to do with that one when it comes to forecasting. Continuing the pattern that we've seen for a while now, we think that there is that flight toward affordability, and that we're going to continue to see that Sunbelt and Midwest markets do better than the coastal areas. To some degree, the suburbs will do better than the urban core in most places. And certainly we think that garden apartment will do better than the mid-rise or high, and particularly the high-rise product. And when I say that, think about what that means in terms of if you're doing acquisitions, look for deals where the cash flow works with the current rent structure, assuming that you don't actually do anything to the product to upgrade it for a little bit. And if you do some product upgrades, probably don't go over the top, because the lower price tends to be the real selling point among renters at this point. And we look at place after place and see that in terms of how quickly a vacant unit turns, it's always that cheapest version of the floor plan that is being offered. So certainly pay attention to how much you might push rents in the near term. We didn't really talk a lot during this presentation about operational practices, but man, they've really changed a lot. And scrambling to adjust to this world where you're doing virtual leasing, virtual payments. A lot of things have changed relative to where we were just a few months ago. And frankly, as we talk to operators over and over again, they tell us it's not going back. That this is, even if you can do things on site in terms of serving the resident, you're still going to keep that online. And then also just in terms of internal business practices, anything you can move from the site level to doing it offsite, that tends to be the direction that we're going at this point. And then one final point is that the capital appetite for apartment product is still really huge, and that it really hasn't lessened at all, except in a handful of niches. And to some degree, we think that in fact that the desire to deploy some capital in the apartment space is going to get stronger and stronger over the next couple of years, simply because it's a better option than some of the other real estate products out there. So a lot of money going in this direction. So if you're trying to buy a property, you're going to have a bunch of people that are other people that are looking at the individual deal, and don't expect any fire sale pricing here. That's just not going to happen. And if anything is going to happen with cap rates, they're going to compress a little bit more. So those are some general thoughts that I have out there. I'll throw in a plug for our blog, as you can see there, realpage.com/analytics, where we're putting out new information virtually every day. So having said that, how about some questions?
So are all those people like, I'm moving to the suburbs?
They're waving their downtown San Francisco apartment goodbye.
Buy $4,000 rent.
Yeah, it is. Well, I will put in a blog that I had in the last few days. I pointed out that while you've had these huge rent cuts in some of these coastal markets, the average monthly rent in New York is still more than $3,000, and in San Francisco, it's like $2,800 or something like that. It's not like we're giving away these apartments in these metros.
So thank you, Greg. There's a ton of information in there. I tried to keep track of most of it, take notes here. But if you guys have questions for Greg, I will maybe try to take your screen share off, Greg. And if you guys want to raise your hand, if you have any questions, or put it in the chat, I will try to call on you. And let me pull up maybe my screen. So raise your hand if you have any questions for Greg, and we'll try to call on you and unmute you. Or if you want to just put it in the chat, we can do that as well. But just to get it started here, let me see. We had 100 questions come in. I narrowed it down a little bit for you, Greg, but let's maybe start, make sure we hit all these. So I don't know, did you spend much time on the election, or is that like we've already moved past that and we're on to the next thing?
No, it's a great question. So I would say, and I will share, I think this is the consensus opinion, but it's also my personal opinion. I feel like we probably got the best possible result in a couple of categories. In that obviously what happens to the economy is directly tied to what happens with the pandemic. These are two sides of the same coin, and regardless of what you might think about our current president, clearly Joe Biden is going to be more proactive in trying to handle the pandemic. Whether he will be successful or not, I don't know, but we're obviously going to take some steps to try and shorten the period of pain as much as we can. So I think that's good. If you have concerns about a Biden presidency, and it's mentioned there, it's what he would like to do with tax structure, and particularly from my perspective, what he would like to do with capital gains taxes and get rid of the 1031 exchange program. But now he's going to have to get that through Congress, and if Republicans still control the Senate, some of those tax changes are going to be a hard sell there. So I think we get the better result on what will happen with the health crisis, and then it's not as bad as it possibly could be on the taxes. I'll take that. And also I will say that regardless of what policy ends up being, what you really want is just lessen the uncertainty and the chaos. And even if you're telling me these are the rules and I don't like the rules, as long as I understand the rules, I know what to go do. Right. So I think that's helpful. So I talked certainly about evictions and moratorium, and we don't think that's a big deal, but we'll see.
Okay. So we covered most of this. Any, in terms of jobs, population, rent growth, anything else you wanted to add on these markets?
I think, frankly, we're amazingly aligned on this list, and I'll be honest that I know you sent that to me, but I didn't fully digest it, James. So I just automatically answered what your questions were going to be.
Okay. All right. Perfect. We talked about urban, suburban. Maybe, did you guys show any slides on secondary and tertiary versus primary in terms of just sort of outside the city center, let's say San Francisco versus like a Sacramento or yeah.
Yeah, and I didn't show on that, but it was like a great comparison there, Sacramento versus San Francisco. And so if I look at rent growth leaders among big markets across the country, it's the not very sexy ones. And so Sacramento is doing really well, picking up some people who were leaving San Francisco. Riverside's doing incredibly well, picking up some people who are leaving LA. A couple of other ones that are standouts. Memphis is doing really, really well, which people don't realize. Some people don't realize that Memphis is a big product distribution hub. So that's helping their overall economy. Virginia Beach, which is a defense industry place, is holding up really well. So, and interesting, I want to say in our top 150 markets, 39 of them are in the Midwest, and everywhere except Chicago and Minneapolis actually has rent growth in the Midwest. So some of these not necessarily would be at the top of the list, particularly for institutional capital, it wouldn't be at the top of the list. Some of those markets are doing really well.
Okay. And I don't know if anyone has an answer to this one, but it's always easier to draw the curve up and down, after the fact. But picking where we are in the market, have we had 2 quarters of negative GDP, Q1 and Q2? Now we're coming up. Do you guys even forecast that, or do you have any? It can be just your opinion on
it's depending on how you define a recession. We could technically already have had a recession and we're pulling it out of it.
The shortest of all time.
Yeah. I mean, the deepest and shortest of all time, and that we've begun the recovery for the economy. But having said that, again, let's circle back to what I said at the beginning. We lost 22 million jobs and we've gained back half of them. So that means we're still behind by 11 million. I'll point out in the great financial crisis, we lost 9 million. So our hole is still bigger than that last recession by a little bit. So I don't know that I would call this recovery yet. And for what happens in the apartment market, we think that 2021 is basically a write-off in best case scenario, and then you begin to actually get some momentum in 2022, and then going back to some of these urban core situations and coastal markets, add another year at least to those, and do not underestimate the ability of local officials and legislators in these coastal cities and states to really screw this up and make it take twice as long as it would otherwise.
Jamie Arnold had a question. Are you seeing minimum wage increases in several states helping out apartments / tenant retention during COVID? Any ideas?
Well, I would say, hey, I haven't looked at that specifically or thought about it that way. As we're looking at as what we're thinking is happening in the marketplace overall, we kind of look at things in the total picture rather than try and focus in it, particularly in our forecasting models. I mean, you'll have a range of positive to negative options there that are all statistically valid choices, and rather than try and model every single variable, although we have hundreds of variables that actually get modeled here as we're going through these, we're going for does it overall make sense rather than does that one specific point make sense?
Right. Okay. Let's see. Let me jump over here. So we had maybe we'll take some quick fire questions here from specific people. All right, let's see. Here we go. All right. So maybe we'll try to hit these with, I don't know, 30 seconds to a minute answers, I guess. Biggest opportunity and biggest risk in each major Texas market came from Amanda Larson.
Well, I'll take the easiest one first. Is Houston is the energy sector and what's going to actually happen there. I think that as you go to other spots, Dallas Fort Worth, it's the construction level, and I would tend to say that San Antonio, it's it can just be that it gets overlooked relative to some other places. And then I think I was, I mean, again, being honest on Austin, we don't get the numbers that are showing up right now. So I'm not sure what's holding Austin back. So our tendency is to forecast, to think that's just a blip underperformance and to be pretty aggressive on that one going ahead, but we'll see.
Okay. Maybe Kelvin asked top 10 markets in the US for 2021. Maybe let's do top 5.
Well, now I will say in general, here were our opinions going into pre-pandemic, that our favorite spots were Texas, and particularly Dallas, Fort Worth, and Austin, that Carolinas, Tennessee cluster, so Charlotte, Raleigh, Nashville. We liked Atlanta, we liked Phoenix. The one that we had on our preferred list that we would have to drop off in a big way now is Orlando, and insert probably Denver in for that one. And then looking at other Florida markets, Tampa's actually holding up pretty well. And then looking at gateway markets, again, I think all of them are a struggle to some degree, but almost always our favorite of the gateway markets is Boston.
Okay. Luke asks, what parts of the supply demand in Texas is no one looking at currently?
Well, in terms of building activity, I will point out in Dallas Fort Worth, the volume is where it's been for the past few years, but we're spreading it out a little bit better than we have in the past. And so, in town Dallas and Frisco and Allen McKinney are still in the top spot, but they've actually come down meaningfully from where they were. And so we're now building in some places that maybe we didn't in earlier in the cycle. I was looking at a list the other day, and suddenly Haltom City was like a top 10 construction market, and my reaction was, where did that come from? And and Garland is getting pretty active as well. So we're mixing up the neighborhoods. Houston, man, we're still building a lot, and we're building in the exact same places where we have been building. So that's a little bit challenging. Austin is pretty active everywhere. And then interestingly, frankly, if I were focusing on development, I would look in San Antonio, which has been trailing off, and particularly what has tended to be the most active, that far northwest portion of the city has almost nothing under construction now. So that's where I think the construction numbers are going to come into play.
Okay. Richard just added a question here. How much, if any, effect might you expect from failed/foreclosed hotel conversions to multifamily? So new supply coming out of that.
It's an interesting question, and I'll point out, we get this one and we get the, hey, aren't all these malls going to become apartment sites? And like, well, probably not, but the hotel one actually is an interesting one, because you could convert some of these existing buildings into some housing. It wouldn't be that big of a stretch. So I'm not going to put a volume on it, but I will say I think it actually will happen to some degree.
Okay. So like the Residence Inn along I-35 that just isn't working anymore.
Yeah,
It's all studios now.
I think the prospects for that are not great.
Joshua asks, are investors moving to new construction versus buying value add deals? So you talk to a lot of investors, you give a lot of presentations. We've seen this sort of drift like to newer product, to newer stuff, just because the value add, the cap rates are so low that they're essentially the same as the Class A stuff.
It's hard to make the value add deals work, but there's inherently more risk in development than there is in buying existing product. So I think it's going to be a mix. I don't know that I've talked to any investor who is going to go
start building
do a lot more than they have done. They're not necessarily cutting back, which I think that's, if you go back to that last recession that we had, we actually cut deliveries by 60%. And that's not going to happen again. It's going to come back a little bit, but it's not going to be anywhere close to that level of retreat. So I think there's capital out there seeking both development and value add as well. But I don't see anybody especially eager to go, let's start a tower in downtown San Francisco.
Right. This question came in from Colin on the chat, just in terms of any comments on rent growth, maybe by unit size or by bedroom. Are you seeing more demand sort of for the 2-bedroom over the 1-bedroom, just because people see that as maybe an office instead of just living there from now on?
It's not super pronounced, but yes, the larger floor plans are doing better in the nation as a whole. And particularly, again, as we trash these gateway markets, there are so many vacant studio apartments in San Francisco and Manhattan that some of the owners are actually converting those into office space within the building, and they're treating it as rentables for their existing tenants, that you, rather than working in your unit, you can come down to and work in this vacant studio apartment.
Like a WeWork.
Yeah, exactly.
Yeah. Okay.
So, and it's not as pronounced in Texas, but I would still say overall that the bigger floor plans are doing a little bit better.
Okay. Jim Biggs asks, do you anticipate a major correction in pricing in any market class or market area?
No. That's
a short answer. That's perfect.
That's a short, yeah, exactly.
Okay, so Amanda has a question. So obviously collections are being impacted because of COVID, but what about on the expense side for any of these operators, like taxes, insurance?
Yeah, exactly. Property taxes and insurance, as we talk to owners and operators, man, it is a beating. The other thing to watch is just kind of the wear and tear that comes from having people in their units all day, every day. And, instead of running the dishwasher every 3 days, you're doing it every day. And so I think just the appliances and some of the fixtures are going to wear out faster. And then it's interesting, whenever I talk to operators, how often they bring this up, just the cost of PPE equipment for the people that you have on site, that in fact that's pretty expensive, and you're using a whole lot of that relative to what you were before.
Well, you're using none before.
That's a good point. It's a good point. Well, maybe you had a mask for the maintenance guy for some certain jobs, but but everybody didn't wear masks all the time. Every day.
Yeah. Larry Snyder asks, which cities, this is very tricky, next upcoming market, not the next one, but the one after that one.
Well, I will say that there's so much transparency now. I don't know that anything ever really flies under the radar. Um, so I think it kind of comes down to what degree have we changed the way we work? Does that really make it a completely different equation? And then also at the same time, then how price sensitive are we? And then to what degree, if you actually really can, and with a lot of careers, work anywhere, to what degree does the cool factor come into play? Because I mean, there are markets where people just inherently want to live, and some where you live there because that's where your job is.
Yeah, I was listening to another economist, and he was saying like the urban markets are going to dump out now, but then the next year's college students, they're not even going to remember this, and they're going to go right back to New York and San Francisco and start moving on
And
as soon
to
as we have a vaccine, right? I mean,
Yeah, I mean,
that's
to some degree, I agree with that. In that, again, we do 5-year forecasting for these gateway markets. I mean, the first couple years are bad, but we have pretty significant comebacks modeled in when you get to years 3, 4, and 5. And again, you get the vaccine, you get that lifestyle recreated to some degree, and you're offering it at a cheaper price point than where it was before. So I don't think the people who have left are coming back, but again, there will be a new wave of 25-year-olds who want to live in Manhattan and want to live in downtown San Francisco and want to live in mid Wilshire and Hollywood in LA, and want to live in Capitol Hill and South Lake Union in Seattle.
Pratima Sharma asks, what do you think about Class A in suburban areas versus urban? And then has the civil unrest in CBDs chase these guys out? So we were just talking about that. So maybe compare a Class A suburban deal versus Class A urban deal right now.
I mean, certainly for the near term, the suburban deal is going to outperform a little bit. So, circling back to what we were saying, and in these markets, again, downtown's not dead in any of these markets that we were highlighting today in the Sun Belt, but it's still going to, from our perspective, underperform the suburbs for a year or two. I think the civil unrest question is a really interesting one, and frankly, with my team of economists and analysts, we've kind of debated that, and I will say within our own staff, it's mixed opinions. I don't think there's a right or wrong answer on that. Other than I will say, there's clearly been enough deterioration in quality of life, including perceived safety, that Manhattan and downtown San Francisco have to change for them to remotely come back to where they were.
Okay. Fritz asked about cap rates, and let's say in Dallas it's 4, 4.5, and 5 right now between
Sure.
A, B, and C. Do you expect any separation between those asset classes, or just slam them all together at some point, and everyone's a 4.5?
Yeah, I mean, when I look at the amount of capital that is going to be coming to these to Texas, and again, the other pockets that I talked about, Carolinas and Tennessee, Atlanta, um, we're just going to continue on the path that we've been on cap rates in those areas, is my general thought.
Okay. Tom Lafferty asked about any impact on tertiary markets. So not urban, but further out, tertiary markets affected by COVID. Any general thoughts there?
Um, again, we're having that flight to affordability. You certainly have. The farther out you go, the more affordable it's going to get. But as when you get really out there, I mean, that just appeals to some people, and regardless of how affordable it will be for others, no. I mean, you eventually get to a point of, I just don't want to live in that environment. And again, for that area, those areas, again, they were slow for the spread of COVID. But I mean, as we're seeing now, once it gets there, what do you do? Because you don't have the healthcare facilities to deal with this. And so I think that in some places, the results are, frankly, I'm looking at the Dakotas now. The results are going to be so bad that I think that there will be a block of people who don't want to live in that environment regardless, because there's health risk in living in that setting. And I'll point out, this is coming from a guy who grew up in a town that was 1,000 people, literally one stoplight. I mean, there's that's cool in some respects, but if you want healthcare, if you want a lot of basic things, don't hang out there.
Don't hang out there, right? This Chip asked a question around Class A residents versus Class C residents the next 6 to 18 months. And I think I know the answer, but maybe just what do you see, how that's going to impact your property?
Well, again, it's going to be a competitive environment in Class A, because we still got to deal with this construction, and people have the option of, if they're not going into the office every day, they have the option of living in cheaper neighborhoods. So again, I think that for the next 18 to 24 months, Class A is pretty challenging. Class B is kind of the from our perspective, the sweet spot. Class C is outperforming right now, but I do think that there's risk there. And particularly if we do not get additional financial assistance for those who are unemployed, then Class C could deteriorate very quickly. That's not our baseline scenario, but I think we need to realize there is that risk there.
Yeah, I mean, Hap Burden had this question around, most people get unemployment for about 6 months. And so if you've been getting unemployment for 6 months, you got your stimulus. Now, I guess what happens when that runs out?
And so if we do not, and the media has finally started talking about it this week, that it's really the end of this year. If we do not have something in place to help these unemployed people as we move into the beginning of next year, this could get ugly quickly.
Omar asked, I think around single family, there's a forbearance moratorium, and single family, it seems like, has been on fire because nobody has wanted to move and rates are low. What are you seeing? I don't know if you guys track single family rentals at all, but just the general single family market and how its impact on multifamily would be.
Yeah, and well, I will point out, single family rentals are doing really well, and part of that is just demographics, and that you have a lot of the older slice of the millennial generation who's now in their well into their 30s. The oldest of them are actually even pushing 40 at this point. It took a long time, but they've coupled up and they've had kids, and so they're in that single family demographic for the most part. But some of them have not, either can't afford to buy, partly influenced by student debt, or they've just opted not to buy yet. So there are a lot of those households that are renting single family homes. That's certainly a growth sector. In general, I would say, though, that the demographic of who lives in an apartment versus who lives in a single-family home, whether it's rental or for sale, is so different. Don't worry about what happens in the single-family market. I mean, and more often than not, single-family and apartment move together in terms of general momentum rather than moving opposite from each other from the trade-off. But again, the demographics are so different. Just if that's your biggest worry, then the world is awesome.
Yeah. Let's worry about taxes. Let's worry about insurance, right?
Exactly.
And collections, right? Let's hit those three first.
Yeah. I can give you a long list of things you should be concerned about. That one is not one of them.
Okay, got it. Todd Horman asks, other commercial real estate investors, are they coming to multifamily now?
Yes.
Short answer.
Short answer. Yes.
They're competing like everybody else. JP Sayers, which markets most heavily impacted and will take years to recover? I'll let you take that one. I think we've touched it, but any particulars that we haven't talked about?
I mean, just looking at where they are right now, and I said that for the average in terms of what's current employment versus where it was in February, the average is minus 6.5%, and that the best ones are in that 3 to 4% category. The worst ones, which include, again, New York, San Francisco, LA, some of the hospitality heavy ones, Las Vegas and Orlando are still down 11, 12% relative to February. So it's just going to take a long time for that volume of jobs to come back. And I'll also point out some of the ones that are super hospitality heavy. Yes, at some point, you're still going to take the family vacation and you're going to take the kids to Disney in Orlando. But is that giant convention business for Orlando and Las Vegas, is that ever coming back? I would question that. And particularly, even if it's safe to do it, a lot of businesses have figured out how to sell what they need to sell without doing that. So we'll see.
I mean, you're the conference king. So
I do. I go to a lot of them. Yeah.
Are there any conferences live right now that you're going to, or is it all virtual?
It's all virtual.
It's all virtual. So I guess until that market comes back, those are going to have a long time. Yeah, because that Monday through Thursday convention business is just gone.
I mean, the in terms of what's on my calendar, the first one that comes up where somebody's actually at this point still saying they're going to do it live is not until June of next year.
Wow. Okay. All right. Dan asks, property class and submarket offering the highest increase in valuation over the next 5 years. So
that's way into the weeds. I can't.
Maybe property class.
I have been stumped on that one.
What about property class? If you had to pick a property class by ABC, let's say Dallas Fort Worth, ABC in 5 years, what's going to have the highest value increase? ABC.
I certainly go Class B.
Class B
is the sweet spot, and I will say go somewhere with medium construction, because the ones with the heaviest construction, like the far North Dallas suburbs and the urban core, you're going to have downward pressure from the top. So a medium construction spot. So I'll pull something. Yeah, no, I'll say like a Carrollton.
Yeah.
Or a kind of just a middle of the road. I guess I'm saying the most generic product and the most generic neighborhood, in fact, will probably be the best. A B and a B. Absolutely. Yeah.
Okay. As long as you don't pay an A price, I guess.
Yes.
I think we touched on that. Workforce versus Class A, adaptive reuse. We hit that. All right. This is like a softball for the technology guys.
All right. I need it.
What is the newest technology you're seeing in multifamily properties, leasing, payment, and amenities? Gary Pierce asked.
Gary, thank you very much for that question. I will highlight a couple of things. Number one, we talked about, hey, renters are continuing to pay. I think that really speaks highly of the success that has occurred with resident background screening products. And I will say that the RealPage resident background screening, it not only measures ability to pay, it also measures your historical willingness to pay, which actually has been a big deal in recent months in some places. We are certainly, you got to have virtual leasing to some degree. The more you can have the complete stack on virtual leasing, the better. Certainly, you want automated payments at this point, as we've been tracking those. The payment numbers over the past few months, you get worse results whenever they're writing the check for you. I mean, it just clearly shows up there. Some things that you maybe not be thinking about is just in terms of an investment that we recently made, was in a company that has again, you got a lot of people on site all day long. They're getting deliveries. You got way more trash than you did previously. So it's electronically monitoring when do you need somebody to come clean out your trash bins, and it's even sensitive to biological hazards and letting you know when there's a problem there. So those are some of the things.
So is it weighing the trash? Is it weighing the trash, and then once it hits like a certain threshold, it just sends
really
the trash around?
Yeah, I think, I know enough about the technology to be dangerous, but not necessarily how it works. I think it's not weighing it. I think it's just that you've got cameras monitoring that something needs to happen, and then the environmental controls on there. And again, other things that are just tied to general spend, the looking for utility savings, etc. But certainly what we're seeing in things with the payments and the tours, and we're not going back to the previous world there. And I will pick up on there was the word amenities in the question, and so I think we are seeing. You don't want to nickel and dime the people to death, but if there are things that could be rentable items that you've been doing for free, certainly people are looking at that.
Can you give me an example of that?
Some of the common area amenities that you can actually reserve use of, that, maybe there are commandants at the pool. There can be, we mentioned in some places where you've used vacant units to do some work from home office space.
I think you've been looking at too many Class A properties with the cabanas.
I know
in Miami, Clark. Oh man, I wish we had some cabanas at some of our properties, but that's perfect. Thank you, Greg, for coming on. I think that was all the questions we had, so I appreciate it. We will send out the slides and everything. I guess, do you want to wrap up with any final comments?
I guess what I would say is we look at where we thought the world would be back in March and April. I think we got to feel good about the fact that we didn't go off the edge of the cliff here, and we're still really well positioned moving ahead. And this is still, you look at various real estate classes, you like industrial too, but I don't know that there's a place you'd rather be than multifamily at this point.
That's right. All right. Appreciate it, Greg. If you've got to jump, I know you did. But I appreciate it, and I'll let you know if anyone has any additional questions, and we'll share your slide deck and your contact information if anyone needs to reach you for any further questions.
Sounds good. Thank you very much, everybody.
All right. Thanks, Greg. Next up, actually, this just came out, I think, yesterday around the lending limits. And so I wanted to see if Fritz is on. Let's see if Fritz is on. I can unmute you, Fritz. And are you there, Fritz?
Yeah, I'm here.
All right. Fritz, maybe give us a little bit of the scoop on Fannie and Freddie came out with some new lending caps for 2021. Everyone got a little nervous that they waited all the way until almost Thanksgiving before giving us new lending limits for next year. So just maybe give us an overview of sort of what we had this year, what volume we got to or expected to get to, and then what we have for next year.
Yeah, sure. It's been quite the wait to figure out what the caps are going to be for 2021. As many of you probably remember, back in 2019, they came up as we moved into third quarter. Both Fannie and Freddie were running out of money based on their current allocation. And so starting in Q4 of 2019, both Fannie and Freddie received $80 billion each for 5 quarters, or $100 billion each. So $20 billion a quarter each for fourth quarter 2019, and then $80 billion for 2020. And so they just released their new cap for 2021, and they pulled it back slightly, but still plenty of liquidity for the multifamily market for both of them. So $140 billion each, or $140 billion total, $70 billion each, which I think it was, I think we were pretty happy with, and it should be a good allocation for capital for 2021. A few changes from the previous cap is they upped the affordability. Basically, they have a percent that needs to be what they consider mission-rich business, and that used to be 37.5% of the total deliveries needed to be mission-rich, and they bumped that to 50%. So there's more of a commitment to, affordable housing, and what they consider mission-rich is properties that have rents that are affordable for residents that earn 80% of the total area median income. And so I think that what that means is Fannie and Freddie have always been committed to providing liquidity for the apartment market, and I think there's just more of a commitment as you move into 2021. They're going to continue to do that. And the thing that they also mentioned in the release is, that the $70 billion for each of them is a starting point. So I think, if demand warrants it as we move into 2021, I think they'll be willing to increase the cap as well. So I think it's a good thing for multifamily investors and owners to have Fannie and Freddie lead the way and continue to provide liquidity for the multifamily market.
Do you know how they're doing on their the $80 billion they had for this year? Are they pretty much up against those?
Yeah, I think it'll be pretty close. I think Fannie will come up just short of their limits, and I think Freddie will be pretty close. So I think both Fannie and Freddie with their goals were try to hit those as close as they could to those targets, and I think they will hit pretty close to that $80 billion number.
Okay. All right. Thanks a lot, Fritz. Any questions, put it in the chat and we'll have Fritz answer them. And I wanted to see if, I don't know if John Krebs is on. Is he on? I wasn't going to see. He might have had to jump off, but I want to go through some recent deals that are on the market that just came out. Glenwood Apartments is in San Antonio, and then Crossings over in Garland. If you have any questions about these two deals, you can reach out to John Krebs or Paul Yazbek. We've sized both of those deals, so any questions on debt, we're happy to answer those. This is a deal, Diamond Lock, that is going to be coming out here in the next week or so. David Fairsing with Fuel and Hoover Group over at Marcus and Millichap is bringing this deal out. It's going to be in the low to mid 140s, 138 units in North Richland Hills, which Greg Willett was talking about. So And then Tradewin. So Tradewin is a 307 unit deal in Mesquite that is out right now. I think call for offers are in the next month or so. So if you have not taken a look at that deal, Nick Flella and Bart Hoover, you can reach out to them for more details on Tradewin. So want to give everyone a heads up on our next speaker series. It is going to be Wednesday, December 2nd with Casey Conway. So Casey Conway is a new speaker for us. He's been in commercial real estate for about 35 years as an appraiser, as an economist. Similar to Dotzauer, he was the director of research over at the Alabama Center for Real Estate. And he's been an economist for Colliers and an appraiser for SunTrust. And he actually worked at the Fed for 5 years. And so he's going to come in and give us his analysis on different items in the economy in about 2 weeks. So wanted to bring that to you guys' attention. And I think that was it on the slides. We're going to go into the breakout rooms now. I appreciate everyone joining for Greg Willett. The first question that we're going to have in the virtual networking is